Welcome everyone to the first of our financial planning workshop. My name is Fred Smith. I'm a registered investment advisor and a financial planner. I'm recently retired. We're going to be doing these investing workshops over the next, well actually financial planning. They cover a whole broad range of stuff over the next 9 months through from tonight, starting with tonight and going through to, I guess it's May of 2017. We're doing these in association with the AAII, the American Association of Individual Investors. We're sponsoring this, along with the Los Altos Library. And the AAII is a national organization, local chapters in about 40 cities scattered throughout the country. And the mission of the AAII is basically to bring unbiased, independent education to individual investors to hopefully protect them from some of the less than honest sales folks that might be out there at times. As I said, this is the first of 9 workshops. We're starting off with the fundamentals of investing, and from there we go to building a diversified portfolio next month, followed by an introduction to computerized investing. And the next one is probably the most controversial on the list, and hopefully get some good arguments going on the active versus passive investment strategies talk. That the folks tend to have very strong opinions one way or the other on that one. So that should be an interesting one. That'll be in December. And that's going to be followed by 3 workshops on retirement planning, including the last one includes safe withdrawal rates, which tends to be an issue for a lot of folks who are in retirement. And that'll be followed by a workshop on Social Security and Medicare, and then we'll finally end up with estate planning. That would be, as I said, in May of 2017. All of these will be on the second Wednesday of the month. We'll be doing them live in person here in the Los Altos Library in this room, and also simulcast on the webcast. And for those folks who want to sign up, I should have actually pointed out on the first slide. You have my email address there if you need to, if you have any questions or disagree with anything I'm saying, which could be quite possible. I'd be glad to accept emails. I'll try to respond to any I get. And the webcast details at the bottom are on SiliconValleyAAI.org. There's actually a typo on your handouts. You need to correct that. The full website is www.SiliconValleyAAII, all one word, .org. If you go to that website, you'll be able to not just get details for the webcast if you want to join us that way, but you'll also be able to access the slides that are going to be showing at each of the workshops, and there will be hopefully a recording available there of this workshop that you can access. I think it'll take maybe 24 hours to get it up online, but you should be able to access that again through that local chapter website. Okay, so for tonight we're going to be doing the fundamentals of investing. Yes. Hopefully, yes. That is indeed the goal. The goal is to record all of the workshops, and they should be available on the website. There may be a limitation on how long they will be available. At the moment, it looks like we can maintain them on the website for a month, but we may have to take them down at the end of the month and put the next one up just because of size limitations. Some of these files are quite large. Okay, so today we're going to start off with your personal investor profile, your PIP. I love the name. The other topics we're going to cover after that will be looking at various ways to measure the return on your investment, and also how to measure risk, because the two are very closely tied together. I will spend some time looking at techniques to control the risk, and mostly the one word diversification comes to mind there, so I would hit that in large block capitals. And then finally, the bulk of the most of the second half of the workshop is going to be looking at a whole range of investment vehicles that are available to us, starting with stocks, individual stocks and bonds, working through funds and exchange-traded funds, closed-end funds, and so on, all the way up to hedge funds. And I'm obviously not going to spend a whole lot of time on hedge funds, but the earlier ones we'll be doing in some detail. And so we're going to be covering, a broad range of stuff tonight. And some of what I'm going to be doing is going to be very, very trivial. When I said fundamentals of investing, I really, really meant fundamentals, because what we're trying to do here is put in place the tools that we're going to need next month and the month after for the rest of it. And a lot of you may know all this stuff already, or at least some of it. Those of you who have a fair amount of experience hopefully will find this a useful refresher, and maybe even find one or two things in here that are new to you. But a lot of it will be very basic. So you just got to bear in mind that we need to cover this and make sure everybody is on board with that by the time we get to the subsequent workshops. So we're going to start off with the personal investor profile. Adam Smith, back in the mid-1700s, said, if you don't know who you really are, the stock market is an expensive place to find out. That just about sums it up. The real message is here is first, know thyself. There's no one magic investment plan that's suitable for everybody. It needs to be customized to each individual's personal likes, dislikes, hopes and fears, what their goals are, what they're trying to accomplish, when they're trying to accomplish it, and so on. And that's what all is spelled out in the PIP. The PIP is really just a one-page at most, maybe even a half-page summary of who you are, and as an investor. And it starts off with the personal data. You basically should put down start with a paragraph, giving your age, your spouse's age, whether you're still working or not, if you're retired already, or when you plan to retire. Do you have children? Do you have to provide a college education for children still, or is that all taken care of? Is your mortgage paid off? What are your hopes and dreams, and what are your worst fears and nightmares? This is all stuff that, if you were to go, for example, to a financial planner and say, hey, here's this portfolio, I want you to manage it for me, the first thing he would do, hopefully, is sit down with you for an hour or two and go through all of this data and write it all down so that he knows what you are trying to accomplish, what you're trying to avoid, the things that are important to you. So you should, the first opening paragraph on your PIP should be all of this personal data that that summarizes what you're trying to accomplish. It basically answers the question, who are you? The next item on the PIP is just a one or two sentences. What time horizon are you working for? Are you shooting for using this portfolio in the next year or two, perhaps for a vacation, 2 years down the road or something, or are you looking more for long-term goals? Is this portfolio to be used for retirement? Well, you might say it's 10, 20, 30 years off. Perhaps even your retirement may be taken care of, and it may be that you're managing the portfolio for a legacy that you want to leave. So your PIP should include some notion of what the time horizon is that for the portfolio that you're going to manage. The risk tolerance is the classic question. It's the eat well versus sleep well trade-off. Folks figure, well, if I take a lot of risk, I can eat well, but I can't sleep nights. That's no good. The other end of it, if you're not getting enough return, there may be a problem there. So, each individual needs to answer that question for themselves, and there's no right or wrong answer. It's just an individual introspection. You go to a nice quiet corner and sit down and figure out, just how much risk, am I comfortable with. Just in passing, most folks tend to overestimate their risk tolerance. And, when the market's going up, it's really easy to overestimate your tolerance. You figure, I'm an aggressive investor, no problem. I can live with a little volatility and so on. But the problem is, if and when, I should say when we get another bear market, if you get a 50% drop or something like that, if you've made the wrong assessment for your risk tolerance, you can be panicked into doing all the wrong things, when the wheels start to come off the market, and obviously that's not good. There are risk tolerance questionnaires out there to help you a little bit. Your favorite broker or mutual fund family, all of these, if you go online, you'll be able to download a questionnaire, typically 1 or 2 pages, to help you figure where your risk tolerance lies. And then the next question that you need to answer relates to whether you want to manage this portfolio for income. If you're retired, that may be an important part of it, although frankly we'll be showing later that may not be the best way, even if you are retired, to manage your portfolio. Or are you looking for long-term capital gains? There should be one sentence in your PIP. Maybe there shouldn't be more than a sentence, basically defining what type of returns you're shooting for with this portfolio. The final item on your PIP will relate to your tax status. If you're in a high tax bracket, you might manage the portfolio in one way. If you're in a low tax bracket, it might be a completely different strategy might be appropriate. You also need to consider the AMT, the alternative minimum tax, and you need to be aware that some so-called tax-free investments, muni bonds come to mind, may even be taxed in the AMT. So you got to watch out for that. But in general, on your PIP, you should have enough information to define what your tax burden is, both federal and state. Now, when you're doing all of this, obviously everything I've said is fairly stable. It shouldn't be flip-flopping and changing from day to day, week to week, month to month. You should go, your PIP should be dull and boring, collecting dust most of the time. You should be stable for 5 or 10 years. Things that would change it might be, if you got married or divorced, or maybe had more kids or something like that to put through college. Things like that might change it. But it should take life-changing events to change your PIP, with the one exception being that as you get older, your goals will change, and there's a sort of a life cycle that you go through. So your PIP will change maybe every decade or two as you work from early career through late retirement. What I'm showing here are just some typical parameters that might apply. Again, there's no right or wrong here, but very often you'll find that somebody in the early career would presumably have a long-term time horizon because they've got their whole career ahead of them. If they make some mistakes, it's not the end of the world because they have time to regroup and correct them. Risk tolerance would usually be high for somebody in their early career. Income needs, they wouldn't need them. They'd very often be in a low tax bracket because, short of working at Google or some of these other places, their salary may be a little on the lower side. But as they work through their career, those things change to the point where, for example, at late career, there's still a long-term time horizon, but their risk tolerance now would be somewhat lower, and the tax status would probably be at the maximum, towards the end of their career. And as they get into late retirement, you note that I've still got a medium time horizon down, because frankly, I don't think that I would ever see situations, or very few situations, where you'd ever put a short time horizon down, for retirement, because even if you're 90 years old, you're still hopefully looking 10 years out there. And I can't see anybody saying, well, I've just got worried about the next 1 or 2 years. Perhaps if you're unfortunate enough, had a diagnosis of a fatal illness or something, then that might change. But in general, mostly you should be thinking long term. And as we go through these workshops, I think you're going to see more and more, the emphasis on long term investing. Obviously, in late retirement, your risk tolerance is going to be pretty low, because you can't, if you make a mistake, you've got very little opportunity to correct it at that point. Typically, you'd be looking for some income from your portfolio at that point too. and tax status will be low because you won't be having a salary come in. So this sort of gives you a typical progression of how your PIP might change over 40, 50 years. But short of reconsidering it maybe every decade or something like that, you should not be tweaking it every few months or every year. If you find that you're changing it or not comfortable with it and have to go back and change it, means you haven't thought enough about it. You really need, I think, to sit down in a nice quiet corner and work through this carefully, because it is an important decision. And as I said, if you make the wrong choices now and the market starts to fall apart and you go back to your PIP to see what it says you're supposed to be doing, it's not good if you don't agree with what it says there at that point. You'd better buy into it. Any questions on the PIP at this point? Are there any? I'm going to move on to the. If there are no questions on PIP, I'll move on to the next. I think we have some questions at the back. Okay. One of the questions that's come in from the webcast is how do we determine risk tolerance? The easiest way to do that, to get a quick look at it, is to go online to your favorite broker and download the risk tolerance questionnaire that they'll almost certainly have on their website. Almost all the brokers and mutual fund families and all have a questionnaire on their website for just this purpose. Now, that does not mean that you want to totally believe everything. Well, if you work through the questionnaire, what it's likely to do is break down two sections. It'll determine whether you're a short-term investor or a long-term investor, and it will determine whether you want to be conservative, very conservative, moderately conservative, or aggressive or whatever. And based on that will be used at a later point to calculate what you should use for your asset allocation in your portfolio. The one thing I would say here, though, is that when you are determining your risk tolerance, be a little skeptical of the answer that you get on the questionnaire, because, like I said, people tend to be overly optimistic. Just as a double check on it, I suggest you do something very, very simple, but also something painful. Go back and look what you actually did in 2008. Go back and look what you actually did in 2000, 2001, 2002. If your risk tolerance shows up that you're moderately aggressive, go back and see if in 2008 you got panicked into selling at the bottom, and that's likely to happen again in 2020 or sometime down the future when the same scenario plays out. So that's a way of double checking the tolerance that you get from the questionnaire. I don't know enough about it. Do you want to mention it?
Hi, this is the producer. Just so you know, there's a gentleman named Sanford that's broadcasting video. That's fine. But everybody can see you. So in case you're worried about your privacy.
Okay. Now we know, folks. The phone number, I'd prefer you emailed me, but I'll give you the phone number if you want it. 408 370 9009 009. Now, I really would prefer if you emailed Fred at fredsmithfinance.com. It's on the title slide. It's on the first slide, if you have the handout there. Fred at, let me bring it up here. It's right there and right here. Email Fred at fredsmithfinance.com. Oh, okay. So we finished with the personal investor profile at this point, and we're going to move on to the various ways that we measure the return on our investment. Obviously an important parameter. This is a very fundamental slide. We're defining total return, first of all, because frankly to me that's the only thing that really matters. And the total return is the sum of the interest or dividend income plus the capital gains or loss realized when you sell the investment. For example, if you bought a stock at the beginning of the year for $100, you received $2 in dividends, then you sold the stock at the end of the year for $107, your total return is 9%. It's the 2% from the dividends plus the 7% from the capital gain. Very, very, very fundamental, very simple. What you should also be familiar with is the term real return. Real return is defined as the nominal return that we've just calculated less inflation. That means that if inflation was 3% for the year, then the real return on this investment would be the 9% nominal return, less the 3% would be 6%. That 6% represents, the purchasing power of your investment. You may have had a 9% return, but the rest of the world has come up 3%, so you only basically get an effective 6%. That's called the real return, and you probably see that in a lot of the literature. We need to look at the time value of money. Obviously, a dollar in hand today is worth more than the promise of a dollar tomorrow. So if you're going to be paid in tomorrow's dollars, you need to make sure that you're getting more of them to make up for the fact that they're worth less. The equation I have here is a very fundamental one. You've got the future value is equal to the present value times 1 plus the rate to the power n, where n is the number of periods. You also see that same equation the other way around, rearranged. We say the present value is equal to the future value divided by 1 plus r to the power n. There are 4 parameters here, and if you know any 3 of them, you can calculate the 4th. Now, if anybody has a financial calculator, you basically just plug in any 3, and it will spit out the 4th one for you. The present value equation we're going to be looking at, or using actually a little later tonight, for calculating the intrinsic value of a stock, where you're looking at the cash flow, the dividends that are paid out, in future year after year after year. You're going to be asking, how can I discount these back to the present value today and sum them all up? So that's one of the uses of that equation in that form. What happens if you want to calculate return over multiple years? Supposing you've got an investment that gives you 9% the first year, negative 5% the second year, and 14% on the third year. How do you calculate the return on something like that? Well, it's easy enough to get the arithmetic mean. That's just 9% minus 5% plus 14%, divide by 3, and it comes out to a nice even 6% per annum. That's not a bad approximation in a lot of cases, especially if you're dealing with shorter time periods, but it ignores compounding. And if you want to take the compounding into effect, you have to calculate the geometric mean, and that's a little more complicated. To do the geometric mean, you have to add 1 plus the percent for each of the years, and then multiply the 3 years together, and then take the in this case the cube root, the 1 over nth root of the multiplied. So you get 1.09, which is the 1 plus 9% is 1.09 times 0.95, which is the 1 minus 5%, times 1.14. You have to raise that to the power 0.333, which is 1/3. And when you calculate that all out, it comes out to 5.69%. Again, a financial calculator will do this for you. You can crank it out easily by hand or on Excel. It's no big deal here, but you just need to be familiar with the formula and know how to do it. What this gives you is the geometric mean, or the compound annual growth rate, the CAGR. Again, you're going to see CAGRs scattered all over the place over the next months. It's also called the time-weighted return. if you have uneven cash flows, what do you do? How do you handle that? Supposing you had an investment with $10,000 at the year one, you added another $2,000 at year two, you withdraw $1,000 in the third year, add another $3,000 next year, and at the end of the fifth year, you liquidate the account, and it's sitting at $17,000 even. How do you calculate the return on something like that? The easiest, or the best way, the correct way to do it is to use the internal rate of return, IRR. And the IRR does not have a nice simple equation. It's an iterative action on, for successive approximations. Theoretically, you can do it by hand, but I wouldn't recommend it. It's a fair amount of work. You have to keep making a guess at what the answer is, and then using the delta between that guess and the real number to home in on it. It could take half a dozen goes around the loop to find it. But obviously, as soon as I say that it is an iterative process, you should immediately think, aha, that's exactly what a computer's for. So to calculate the IRR, the simplest way is to go to any spreadsheet. And, in Microsoft Excel, there's an IRR function, and you just plug in the addresses that contain the cash flow that you're interested in, and hit the return button, and it will spit out, in this case, for these numbers, it will spit out an IRR equal to 5.9%. So, the simplest way to do an IRR really is on a spreadsheet, or in again, a financial calculator will do it. IRR is also known as the dollar-weighted return. You sometimes see that term used. Here's an interesting approximation that works in a lot of cases. Supposing you get a $10,000 investment at the beginning of the year, and you're going to feed that investment $100 every month. At the end of the year, the investment, in other words, you're adding in $1,200, and at the end of the year, the investment is worth $12,000. How do you calculate the return on that? You get a good approximation by the equation I've given you here, which basically says you take the future value, the $12,000, minus half of the cash flow. That's where the $600 comes from. The $600 is half of the $1,200 cash flow. And you divide that by the present value plus half of the cash flow. So you crank through the numbers for that. You come up with an approximation for the return at 7.55%. If you do the IRR on it, if you go to a computer and plug in all the numbers, that will give you an answer very, very, very close to that. The approximation is pretty good when your cash flows are reasonably uniform. But if your cash flows are lumpy, I love that term, or if the cash flows are all clumped together at either the beginning of the period or at the end of the period, then the approximation will be a little more gross, a little less accurate. Yes, sir. It is indeed. Thank you. Thank you for pointing that out. Okay, how do you compare arithmetic means and geometric means? When should you use each of them? I'm a little skeptical of arithmetic means in most cases, especially for longer time periods, but where you sometimes see them misused. They're misused more often than used correctly, I think. Where you sometimes see them misused as advertising for various newsletters. They're going to make all sorts of outrageous claims. And the example I've talked about here might be where a newsletter boasts that they've turned $10,000 into $25,000 over 10 years, and they calculate that that's $15,000 gain over the $10,000 initial divided by the 10 years, which gives you 15% per annum. The math is fine. It's just an answer that's not particularly useful, because the real number is the geometric mean, which is the $25,000 divided by the $10,000 raised to the 1/10th power, and the real number will be 9.6%. That's the compound annual growth rate. So the newsletter is basically using the arithmetic mean or misusing it to exaggerate the returns. I guess the moral of the story here is, beware of arithmetic averages, especially over long time periods. Yes? Yes. Yes, yeah. Most of the spreadsheets, including Excel, have a fairly broad range of financial tools, and I'm not covering all of them by any means here. I'm just trying to give you the ones that you're really going to be running into over the next months. But there's a whole ton of stuff in there if and when you're ready to use it. Yes. Is everybody here familiar with the rule of 72? Just a quick show of hands. Everybody? Okay, a whole good bunch of you know that. It's another quick way of not quite cheating, but it gives you a quick answer for some questions. If you take an investment with an annual rate of return R, and you want to calculate how many years does it take for that investment to double, how many years N, N is actually equal to 72 over R. Or to look at it the other way around, the rate times the number of years is approximately equal to 72. For example, if the rate of return is 6% per annum, that investment will double every 12 years. If you want it to double in 9 years, you have to have an 8% return per annum. And it's a quick way of evaluating how your investment's going to grow. Those of you who are math freaks may enjoy deriving this from first principles. It's a fun exercise, but not necessary for tonight's purposes. Any other questions on the return on your investment? If not, we'll move on ahead to to looking at various aspects of risk. Risk comes, the word risk is defined in a whole bunch of different ways, but the soft definition of risk kind of says, the chances of not having as much in your portfolio when you need it as you'd hope for, or as you'd planned for. The sources tend to be from a number of different areas. There's market risk, which can include industry risk. A whole industry may crash and burn because something's gone out of favor. It can be company risk where the industry is doing just fine, but the company has done something wrong and gone out of favor. If you're investing abroad, you've obviously got to worry about currency risk because your investment may do just fine as long as you leave it in French West Africa and in their dollar, whatever the heck they're using. But if their dollar has crashed and you can't bring the money home, or get a lousy exchange rate, then that's obviously a risk to worry about. And the other thing, if you're going abroad, you need to worry about is political risk. Maybe in French West Africa, or wherever you got your investment, the whole government, there's a coup and they're thrown out, and the new guys get in and decide to nationalize everything. Not every country is going to be as neatly regulated and controlled as the SEC does for us here. And to some extent, we're spoiled here, in the assumption that somebody's got your back and that nothing really stupid hopefully is going to happen. But as soon as you go abroad, all bets are off. Inflation risk is very real. For an investment that if you have a short time frame, it's not going to be an issue. But if you're looking at putting together a retirement portfolio or something that you may not need for 10, 15 years or whatever, or longer, obviously you have to factor in inflation because what you pay for a gallon of milk today is going to look like absolute peanuts compared to what you might pay for a gallon of milk 20 years from now. The other risk that needs to be factored in and that folks don't tend to think of necessarily as a risk is longevity risk. The risk that you will outlive your assets. The statistics show that that the average age for most folks is somewhere in the mid-80s. It's a little older for women than for men. There's a couple of years difference, but somewhere in that region. But that doesn't mean that we're all going to die in our mid-80s. So there's a very finite possibility, even probability that we know half of us will outlive the averages. So for one thing, so you don't want to take the average number at all. And there's a very real possibility that many of us will live well into our 90s or to 100. And this age actually is increasing year by year. You know, if you were to look at the statistics from 10, 15 years ago, I think the data would have shown that it was in the low 80s, not the mid 80s. So, you know, we've already gained 2, 3, or 4 years, you know, over the last decade or two. And then, you know, with advances in medicine and so on, you know, that's likely to continue. So there's a very real possibility that we'll all live longer than we might originally have planned. And then the question comes, well, will my portfolio also live longer? What do I need to do to make sure my portfolio lives longer? Most financial folks don't like the soft definition of risk because, you know, they need to put a number on it in order to handle it and to calculate it in their equations and so on. And the most common way of measuring risk is the volatility around the mean. How much, you know, if you're getting returns of a certain value, how much are those returns going to move, you know, on each side of the mean? What I'm showing here is a normal distribution of returns that are centered at an 8% per annum mean. That's got a 10% per annum standard deviation, which means that if you move one standard deviation above the mean, you're at 18%, or one standard deviation below the mean, you're at minus 2%. And the statistics say that 68% of the time you would expect a return to be within that band of plus or minus one standard deviation. If you go out plus or minus 2 standard deviations, in this case from minus 12% up to 28%, the probability of any one year falling within that group goes up to 94%. And if you go to 3 standard deviations, it's 99.7%. You don't need to know all of this, you know, in detail, but what I wanted wanted you to understand was that just because the mean is at 8%, you know, most equity funds or individual stocks or whatever, you know, you could well find, you know, 8 or 10% is not an unreasonable value for the mean, but the standard deviation is likely to be higher than the mean. It could well be 15% or more. So you're likely to have years that go negative, and sometimes they'll go significantly negative. I just wanted you to not be surprised by that. Just because you've got an 8% mean doesn't mean that you can't show up at minus 5% or minus 10% every once in a while. Be prepared for it. And that, again, goes back to your risk profile. If you're not prepared for it, then you need to rethink what you put in your PIP and, you know, on a more conservative basis and build a more conservative portfolio. The easiest way to do the standard deviation, I mean, again, you can calculate it by hand, but we're not, you know, I don't encourage that. The easy way, again, is to go to Excel. And there's a function in Excel called STDEV. You just you know, scan in the column of numbers, and it will give you the mean value and the standard deviation. Another measure of volatility is the beta. Now, the beta is actually the volatility relative to an appropriate benchmark. You know, a typical benchmark might be the S&P 500 index, although there are dozens of other ones out there. And what we're saying here is that if you have, for example, a beta, you know, a fund with a beta of 1.2, then, do we have a question here? If you have a beta of 1.2, then it's 20% more volatile than the benchmark. And, you know, if the S&P, in a case like that, if the S&P loses 10% over a given time frame, then you can expect your fund or your stock to lose 12%, you know, based just on the beta. Typically, the more aggressive funds will obviously have betas greater than 1 because they're looking to get more bang for the buck, as it were, and, you know, they will typically move in both directions, both positive and negative, more than the benchmark. More conservative folks could pick a portfolio or a fund with a beta lower than 1, 0.7, 0.8, or something like that, so that it moves less than the benchmark and it's less volatile. Typically, for example, dividend stocks or funds will, you know, tend to have lower betas than the growth funds. Some folks figure that, oh, why do we worry? Why do we want to know about volatility at all? You know, if I'm investing for the next 20 years, why do I care how much it swings up and down in the meantime? One reason why you might care is because there's no guarantee that at the end of the 20-year period that it's up when you want it to be rather than down. And that's one of the things that could be a major eye-opener if you get to the end of your period and you've not taken volatility into account. The other reason is because it really does affect your return. What I'm showing here is the comparison between a stable investment and a volatile investment. For the stable investment over 5 years, I'm showing an even 10% per annum return. It's got obviously an average return of 10% per annum. Standard deviation is 0. And the compound annual growth rate, I should be able to point to that. Compound annual growth rate is 10%. If anybody knows this investment, I'd like to hear about it because it wouldn't be a bad one to be in. More likely, you'll end up on the other side of the other columns where you're talking about a volatile investment. And what I'm showing here is something that starts off with 15% the first year, negative 17% the second year, then switches to 25%, 5%, and 22%. Again, the average return is 10%. If you take the average of all those numbers, it works out the same 10% as the stable investment. But in this case, the standard deviation is 16.9%, and the compound annual growth rate is 8.9%. It's less than for the stable investment. You can see that immediately by just looking at the balance is 15,000 and change is lower than we ended up with on the stable investment of 16,000 and change. The volatile investment I've shown here is actually not, it's not that far off what you could easily expect, for a typical stock fund. It's not unusual to have a 10% average return with a with a standard deviation of anywhere from 15 to 20%. So this could be a fairly typical case. It shouldn't be a surprise to anybody that risk and return are highly correlated. Some folks out there, may tell you that they've got this great investment and there's very little risk, and why don't you give them all your money and they'll take care of it for you? They're either very stupid or they're very good liars, possibly both. What I'm showing here is actual data. This is actually an old slide, as you'll see in a minute, where on the left-hand side, we're looking at T-bills, which are backed by the full faith and credit of the federal government. The next 3 points on the graph are for bonds. This will be short-term bonds, intermediate-term, and long-term bonds. Obviously, as you go out to the longer-term bonds, you're getting higher returns, especially if you've got a positive yield curve. We'll be talking about that in a little bit. But the benefit of getting the higher returns, you also have more risk. You've got the higher volatility, higher standard deviation. And when you go out to the stocks, what I'm showing here is the middle one. This one here is the total stock market. And this is the S&P 500, the large cap stocks, and these are the extended market, which would be the mid cap and small cap stocks. So you can see right off that the higher the return that you need to get or want to get, and we need to distinguish between those two, the more risk you're going to have to take, and there's no way to avoid that. And anyone who tells you otherwise doesn't understand the problem. If risk and return are tied together, as we've just seen, it seems obvious that what you want to do is actually calculate the risk-adjusted return. How do you calculate a return that allows for the amount of risk that you need to take? And the standard measure of that is the Sharpe Ratio. The Sharpe Ratio has been around for decades now. To calculate the Sharpe Ratio, you just take the projected return minus the risk-free return and divide it by the standard deviation. The risk-free return is usually taken as the Treasury, as T-bills or T-notes or T-bonds over whatever time frame you're talking about. And so you're going to come across the Sharpe Ratio from time to time as a measure. It's an effective measure of the risk-adjusted return. Another measure that you occasionally see a little less often is the Treynor Ratio, which is very similar to the Sharpe, except that it uses beta instead of the standard deviation. One of the problems with both the Sharpe and the Treynor, I shouldn't say problem, but one of the characteristics that some critics don't like, is that when they use standard deviation, that factors in both the upside deviation and the downside deviation. And most of us don't care all that much. While we're thrilled with the upside volatility, and we're only concerned about the the downside part of it. And there are some other risk-adjusted ratios out there that allow for that. The Treynor Ratio and the Ulster Index are just two of them, but there's a whole bunch of them. And these attempt to just focus on the downside volatility. But for present purposes, if you understand the Sharpe and you can apply the Sharpe to your own portfolio, that's more than enough, to get you through most of what we're going to be covering. Okay, so that's all I'm going to talk about, the measurement of risk. Before I move on to controlling risk, are there any questions? That looks like, well, let me take a question from the back here first. I'm sorry, I couldn't hear you. Can you repeat? That's the same gentleman, absolutely, yes. You're correct, sir. Oh, the question is whether we're talking about the Professor Sharpe from Stanford University. He's a Nobel Prize winner and well known in the industry, and still active to some extent in the industry. Okay, good. We had a question from the web. The question is volatility ever a good thing, or is it always to be avoided? I'm going to give the typical financial planner answer here, and the only answer that I can say with a straight face, and that is, it depends. If you are an aggressive investor who likes to trade frequently and to use the ups and downs of the market and believes that you can time the market, and we'll talk about some of those issues at the later workshops, but if you are one of those, then you probably would consider volatility to be a good thing, because it's like they say in Britain, if it moves, you can bet on it. The volatility certainly gives you the movement that you need, and if you figure that you can predict that movement, then it's a good thing and hopefully works for you. On the other hand, if you're a conservative investor and you're investing for the long term and you don't like to see your investments swing up and down and trying to track them, then most folks would prefer to be in a less volatile situation. Any other questions? One of the comments that I'm getting from the web is that William Sharpe is a lifetime AAII member. I know that he has promoted the AAII on numerous occasions, and yes, he is a good friend of ours. We're glad to have him. Another question. Question relates to low volatility funds and low volatility stocks, and really the question is, shouldn't I always invest in that rather than risk going into the high volatility? Again, it depends. If you go into usually there's a price to pay for everything, and if you stick with low volatility stuff, you're probably going to pay a price by way of the return, and there's certainly some viable strategies out there that do just this, but you need to be careful that you still get the return that you want, even if you do pick the low volatility stuff. Yes, sir. Typical values are going to depend on the time periods that you measure it over. I guess I'm most familiar with Sharpe. What I tend to do in these workshops, at least, is focus on annual data. And as I showed before on some of the earlier slides, it's not unreasonable to get a mean value of 8 or 10% with a standard deviation of 15%. And if you take a couple of percent off for the risk-free return, you're going to wind up with the Sharpe ratio lower than 1. typically, 0.5, 0.6, that sort of area, 0.7 maybe. If you look at bond funds, which tend to be less volatile, but also have lower returns, but because they are less volatile, that tends to override, and you get some Sharpe ratios greater than unity. Another question at the back. Yeah, there's a comment here that some of the low volatility funds got overvalued a little because there are a lot of people, of late that were trying to ride that bandwagon and drove the prices up, and they got hurt a little bit more recently in the recent downdraft because of that. So there's no free ride. You go back to the risk versus return. Oh, another question at the back. Yes. Okay. Now, there's a comment that Bill Sharpe. Yeah. The comment basically was that Bill Sharpe founded a financial engines fund and still runs that. I'm going to move ahead with techniques to control risk. Obviously, not everybody wants to ride the roller coaster all the time, so we have to look at ways to see if we can smooth it out a little bit. The one thing that we have in common here on this slide, and I should have put it in big flashing neon lights, is the word diversification. It shows up here in three times. Diversification of asset classes, tax diversification, and time diversification. Diversification of asset classes is something that most folks are familiar with. We'll be talking next month about building a diversified portfolio. And the first thing you look at there will be, how much of it goes into cash, how much of it goes into bonds, and how much of it goes into stocks. And they all behave slightly differently, and hopefully in different time frames. The goal is hopefully that when one zigs, the other zags, and that you can get some benefit from that. The other form of diversification amongst the asset classes is to go abroad. Domestic stocks don't always correlate with foreign stocks, although the correlation is tending to get closer with time. It's not as useful a way of diversifying as it used to be. But if you go to developed countries, abroad, they may behave somewhat differently to domestic funds. If you go to emerging markets or frontier markets, even farther out there, these may again behave differently to what the S&P 500 does at this end. This we're going to be talking about in a lot of detail next month, so I'm going to leave it at that for now. Tax diversification is something that most folks don't really consider that much. Every penny you own in a portfolio is basically in one of three different types of accounts. It's either in a taxable account, a tax-deferred account, or a tax-free account. Taxable accounts are just a regular account at Schwab that you put part of your paycheck into every month and hope it goes up. Tax-deferred will be your typical IRA accounts, your 401k, stuff like that, where you put dollars in and you get a deduction for the amount that you've invested, but you have to pay taxes when you withdraw the money. And then the final one would be tax-free accounts, which would be the classic example there nowadays is the Roth account, where you pay taxes on the money that goes in, but you never ever pay any taxes as you take it out on either the original investment or on any growth over the years. And one reason why I like to diversify amongst all three of these is because I don't have a clue what Washington is going to do to us over the next 20 years. It's hard enough to understand the tax structure today, but you really don't want to get into a situation where you've made a heavy bet, that that certain tax scenario is going to play out, and that you're going to pick your accounts based on that. Because frankly, I don't think Washington knows what they're going to do, not just in 20 years, but tomorrow. So, I believe in a diversified portfolio, or diversifying across the different accounts here, just so that regardless of what Washington does, none of it shows up as a killer action on your total portfolio. Again, I'm going to be talking about this in a lot more detail when we get to retirement planning. I'm going to be discussing IRAs and Roths and all of those in more detail. The third form of diversification, I think most folks are familiar with, and that's dollar cost averaging is the thing that comes to mind. I think everybody's pretty familiar with that. And there's another form that's somewhat similar to that called value averaging that people may be less familiar with. So let's look quickly at dollar cost averaging first. With dollar cost averaging, you're investing a fixed amount at equal time periods. So we're looking at, in the example here, months 1 through 6, and you're putting $1,000 in every month. The share price of the fund that you're investing in starts off at $10, it drops to $8, goes up to $12, and then returns a bit. So you can calculate the number of shares that you get each month. You can calculate the total number of shares, the share balance, and the total value of the fund at the end of the month. And if you look at the obviously, when you're doing this, the attraction of it is that when the share price is low, you're buying more shares with your $1,000 contribution. When the share price is very high, you're buying fewer shares. And when you look at the sum for the 6 months, you find that you've invested $6,000 even. The share price is an average $10 per share. And the total number of shares that you wind up with at the end of the 6 months is 611 shares. And if you calculate out the average cost per share, it turns out to be $9.83. So, if the market is bouncing up and down and moving sideways, this is a good way to diversify and not place, a big bet, at any one time. You obviously could have, invested the whole 6,000 at the beginning or at the end or whatever, and you might or you might not have picked a good time frame, but this is a way of spreading it out over a number of equal increments and averaging out the results. A somewhat similar form is value averaging. And in this case, what we're doing is adjusting the balance, not the contribution, adjusting the balance each period to a target value. So we've got the same months 1 through 6, but over here on the balance we're initially aiming for $1,000. We want to go to $2,000, $3,000, $4,000, $5,000, end up at $6,000 at the end of the 6th month. So the question is, with the share prices, these are the same share prices in the last example. With these share prices, how many shares do you have to buy each month to get to that correct balance? And those values are calculated, on the spreadsheet here. And it turns out that at the end of the 6 months, you wind up with just over $5,000 in investments, and you've got 545 shares. So it turns out that you have an average share price of $9.52. Again, you see the same thing at work here as we saw in the dollar cost averaging. That when the share price is low, you're buying a larger number of shares, and when the share price is high, you're buying fewer shares. One thing that's kind of intriguing about value averaging, I think, is that it sort of works in reverse as well. Supposing you have a portfolio that you want to liquidate, supposing this were the other way around, that you wanted to start off here with a $6,000 portfolio and get to zero at the end. You could start off with 6,000, 5,000, 4,000, 3, 2, 1, 0, and sell the number of shares that it takes to come down to that target value. Again, that's a viable way of doing it. Okay, so that's all I'm going to do on risk control at this point, except we have a question here. Somebody had to ask the question. The question is it possible to make a general statement that value averaging is always more attractive than dollar cost averaging. I do not think that is true. I think there are some situations, again, we're back to it depends. Sorry. There may be some situations where it would not be the case. I think it depends on what your goals are. I think in general, value averaging tends to be a little more aggressive in terms of bumping up the number of shares when the price is low and the other way when it's high than dollar cost averaging, but it doesn't guarantee that you're going to come out with a better result. Well, if it's constantly declining or constantly going up, then either of them is not going to give you as good an answer as doing it all at the beginning or all at the end. But none of us can foretell the future, and without knowing the future, you don't know whether that starting value is the good one or not at the time. Okay, if there are no other questions on controlling risk, we're going to move on to investment vehicles. I'm going to spend a fair amount of time on this because there's a ton of stuff to cover. What I'm listing here is not meant to be totally inclusive by any means, but investment vehicles range all the way from cash, individual stocks and bonds, mutual funds, closed-end funds, exchange-traded funds, exchange-traded notes, etc., etc. I've included real estate REITs, real estate investment trusts here, and also commodities, master limited partnerships, and hedge funds, and so on. We're going to be spending most of our time at the first half dozen items on this list, and less time, at the end of it. I'm certainly not going to spend a whole lot of time on the bottom item. Okay, for cash and cash equivalents, first thing that comes to mind is your checking account or your savings account, money market funds, short-term CDs, treasury bills. T-bills are by definition less than a year. T-notes then will go above a year, and T-bonds beyond that. But T-bills by definition are short-term, so they're considered cash equivalent. They're obviously also backed by the full faith and credit of the U.S. government, so you would hope that that the safety is there. The overriding characteristic of all of the cash equivalents, it shouldn't surprise you, is they've got stable value with very low return. Stable value means that you're pretty sure that you're going to get your principal back. They're not going to be volatile. You're not going to wind up, that it takes a 20% drop sometime on you or something like that. A lot of them are actually guaranteed to get your money back. You can get FDIC insured CDs and so on. And the T-bills obviously backed by the U.S. government. They're not going to default on that. Money market funds in practice are pretty safe, although there have been occasional examples in the past of money funds that have broken the buck, as they say it, and actually had to discount a little bit what they paid back. That's very, very rare. So, in general, your money is pretty safe, but you're getting, when I say a low return, it's actually a lousy return in today's environment. This bottom statement, I was obviously in a good mood at the time I wrote it, and I was pretty optimistic. I said, may not keep up with inflation after taxes. In today's environment, it almost certainly will not keep up with inflation after taxes. So most of the returns that we're talking about for these cash equivalents are going to be less than 1%. So if you've got 2% inflation, you've got a negative real return right there. So when I said may not keep up, like I said, I was being a little optimistic. Let's look at individual bonds for a minute. A bond, this when an investor lends money to a company or to a government agency, and in return they get periodic interest payments. You buy them through a broker for a commission. In order to build a diversified portfolio, and you're going to need to put together a whole bunch of these, typically 20 or 30 different characteristics. If you're concerned about getting your principal back, if you wait until maturity, when the bond matures, then you will get your principal back. Even if it's a volatile right to get to that point, you get your principal back unless the company defaults or goes bankrupt. One of the issues that a lot of folks don't understand or fully, the valuation of bonds is very time-consuming and it's very, very complex. I personally believe that it's more difficult to evaluate bonds correctly than it is stocks. And individual stocks are bad enough. But I'm not going to spend a whole lot of time on individual bonds, or for that matter on individual stocks, because I'd prefer to encourage folks to look at mutual funds and various forms of pooled investments when we get there. But you do need to understand these individual stocks and bonds and the attributes for them. And I guess what I'm saying is you need to understand them, but I'm not encouraging folks to rush out there and buy a whole portfolio of individual bonds. For a bond, the interest rate and the price will reverse. When the interest rate goes up, the price goes down, and vice versa. It's like being on a teeter-totter. If you consider, maybe if you paid $1,000 for a 5% 10-year bond today, and next week the interest rate goes up to 6%, you're not going to get your $1,000 back anytime soon. It will have dropped because the new investor is going to want to buy a new bond to get the 6% rate, to get $60 on it per 1,000. And there's no way he's going to give you $1,000 to get $50 on the 1,000. So if you want to sell your bond next week, you're going to have to discount it down to maybe $900 in order to sell it. The $900 with the $50 per annum interest rate will work out at about 6%, which a new investor would need. So that's why they move in the opposite direction. Bonds come in all sizes and shapes. One of the first things you need to look at is who the lending agency is. It can be a corporation. Most corporations are a lot of that, especially the big ones, float bonds every once in a while to raise capital for equipment and so on. And then obviously there are a whole bunch of federal, state, and local government agencies that float bonds, and they all have different credit ratings. The credit ratings are provided. The three main agencies are S&P, Moody's, and Fitch. And, they will rate the bonds all the way from investment grade, which could be AAA, down to high yield bonds, better known as junk bonds. Folks don't always understand when they see high yield that those are in fact junk bonds with a lousy credit rating and severe high risk. The term of the bond can be anywhere from a year or so up to longer than 30 years. And the longer the term is, the more sensitive the bond is to changes in interest rates. That's one reason why the volatility is higher, but the return is higher. So again, no free lunch. You should be aware that some bonds are callable. What that means is that the issuer is reserving the right at any point before the maturity of the bond to calling it back and saying, I want that bond back. I'll give you, your dollars back, and the deal's off. In essence, if the issuer, for example, had issued a bunch of bonds at 5% 20-year bonds or something like that, and the interest rates drop down to 2 or 3%, and they have the right to do this. It would obviously be in their interest to call back the bond, pay folks off, stop paying 5% anymore, and reissue the bond as a 3% bond. In the meantime, you're stuck with your money back, but nowhere to invest other at 5% anymore. So you need to watch whether a bond is callable or not. Any questions on bonds before we move on to stocks? Okay, that's good. I really don't want to get into bonds, into the individual bonds too much. On the individual stocks, you own a piece of the action. You own a piece of the company. It may be a very small piece of the company, but you basically got skin in the game, as it were, and you participate in the gains and losses and the dividends that are distributed and so on, and that small chunk of the company is yours, for better or worse. They're traded obviously through a stockbroker throughout the day, again for a commission. If you're going to build your own portfolio using individual stocks, I think you need at least 20 or 25 different stocks make sure that they're in different sectors. There's no point in getting 20 stocks all in the financial sector and thinking you have a diversified portfolio. You don't. And again, it's complex, it's time consuming, and from my personal opinion, and this is an opinion, it's not worth it. If you want to evaluate stocks, there are three main financial statements that you need to be familiar with. There's the balance sheet, the income statement, and the cash flow statement. The balance sheet is basically a snapshot of what the company owns and what the company owes at a specific point in time, typically December the 31st, but it could be running on a different fiscal year. And the kind of thing you'll see on there will be the stockholders' equity, which is computed as being the total assets minus the liabilities. They may give you the book value, which will be the tangible assets less the liabilities. Tangible assets, as the name implies, are assets you can go out there and physically touch. Total assets may include intangible assets, which could perhaps be a patent portfolio, intellectual property, that kind of stuff, which adds to the shareholders' equity because it's obviously got value, but the valuing it is a very difficult thing to do accurately, and there are various opinions on what an intellectual property portfolio is truly worth. Income statement covers a given period of time, either say a calendar year or the fiscal year that the company is elected to use. And there they might compute the net earnings, which would be the revenue minus the expenses. One of the things that falls out of the equation will be the dividends, which would be the net earnings per share times the payout ratio, because they don't necessarily pay out all of the earnings in dividends. In fact, they almost certainly won't, because they want to plow some of them back in again. Then you've got the cash flow statement for a given period of time for the year, and that will look at the activities for operating, investing in the financial activities. And again, if you want to evaluate individual stocks, you need to be familiar with these three financial statements. You need to be familiar with a lot of the ratios that are computed when they're doing an analysis of a given stock. Most of the numbers on the financial statements wind up in these ratios, and the usual way of evaluating a stock, of analyzing a stock, is to compute some of these ratios. The price-earnings ratio, just the market price divided by the earnings per share. The dividend yield is sort of that turned on its head with a little twist. And that's where the annual dividends per share divided by the market price. The market price is the numerator in the first one and the denominator in the second, which is why the dividend yield is, in fact, a yield. The other way of evaluating a stock is the discounted cash flow model, where you compute the intrinsic value. And that's what I was talking about, at the beginning of this workshop, of how you compute the present value of a future stream of cash. Each year, the company will be projected to spin off X number of dollars this year, a different number of dollars, each year. And what you got to do for each of those years is discount that value back to the present value and add them all up, and it'll give you the intrinsic value of the company. You can compute this yourself, but it's more likely that you go to some of the services, newsletters or whatever, to look for this data. But again, individual stock analysis is time-consuming and complex. Anything on stocks before I move on to mutual funds? Okay. Mutual funds I find a lot more intriguing because they're, by definition, a pooled portfolio of stocks or bonds. So you get the immediate diversification here, and they're somewhat easier to evaluate than the individual stocks and bonds. Mutual funds are traded at the net asset value at the end of the day. So at the end of each trading day, all of the stocks in the fund, in the portfolio, are valued, and the balance of the fund is calculated, and that's what gives you the net asset value. They're traded through either a mutual fund family. You can, if you shares with Vanguard or Fidelity or T. Rowe Price or whatever, you can get on their website or call them up and trade them. Or in most cases, you can trade a lot of these through any stockbroker. The stockbroker is likely to charge you a commission for it. With the mutual fund, with the fund family, you probably don't have to pay the commission. The folks that are running the fund can generate more shares as needed, or liquidate shares as needed. So you'd never run into a situation where you want to buy something and sorry, there aren't enough shares to go around. There are always shares available. Typically, they're going to distribute all the income and capital gains each year because at the end of the year, they're legally obligated to distribute 90%, and most of them, in fact, actually distribute all of them at the end of the year. Yes, there's a question back here. In what Okay. Okay. The question relates to how do we evaluate the mutual funds? Is there a way to evaluate mutual funds? Yes, there are all sorts of ways. There's a bunch of websites, that compare the funds. Well, first of all, the funds we see get divided in, by a number of different types of funds. Some of them, bond funds and stock funds. In the stock ones, there may be large caps or small caps, and could be value funds and so on. There are a number of websites out there that contain a lot of information on that. One of the ways to evaluate it that's actually you should all be aware of, and that is anyone who has a library card here has access free to 3 different services online that includes Morningstar, it includes S&P, and it includes, I can't remember, Value Line. And if you go on any of those websites, you'll find more data on the mutual funds than you know what to do with them. And the trick is really to pull out just what you want and do it. But at the end of the workshop, one of the slides I have gives you the website for the library here. And anybody who has a library card, and you don't even have to be a resident of Santa Clara County, it's all for free. You just have to sign up for the library card, and you'll have access online for free to those 3 services. Also, of course, on AAII, on our website, there's a whole bunch of tools on that as well that you can go to evaluate them. The mutual funds come in a whole huge range of, of different types. All of the early ones initially were passive funds that tracked a given index. In fact, the S&P 500 is one of the favorite ones that almost everybody offers a mutual fund to track that. But there are a number of other ones now, and there are also a number of active funds becoming more popular, and those have an objective. They have to state the objective right up front in the prospectus as to what they're trying to accomplish and how they intend to do it. Mutual funds are run by a management group, and that obviously means fees. Somebody has to pay for them. Some funds, when you buy them, have a load, either a front-end load or a back-end load. Front-end loads mean that if you spend make a contribution, say of $1,000 to a mutual fund, they may take 1, 2, 3% up to 5% or more as their cut of it for running the fund. I think 5.75 is about the highest they do now. I think they used to go up as high as 8.5. I'm not sure if that's even legal anymore. With the back-end load, it works the other way around. You don't, if you give them $1,000, the full $1,000 gets invested. But if you try to redeem the fund and sell it, within the first year, they'll typically take 5% cut at that time, and normally the back-end loads decline each year. So it might be 5% if you sell within the first year, 4% if you sell in the second year, 3%, 2%, 1% going down to 0. Having told you all about the load funds, I don't think in practice you really need them. I think everything you need is probably going to be available as a no-load fund, and I see very little reason these days of paying a load on any fund. Back in the old days, funds like Fidelity, Magellan, and so on, that really were very popular and very great performance and all the rest of it. People didn't mind paying a small load to get into it, but that's not the case anymore. Most everything you want I think is available as a no-load fund now. But even if you get a no-load fund, you're going to have an expense ratio to cover because there'll be some management that needs to be paid, and the management fees can range all the way from less than 0.1% up to 2% or more. Typically, the passive index funds are the very low expense ratios. In fact, some of those can be in the region of 0.06, 0.07% or something, real low, almost negligible. On the other hand, if you get an active fund, where the management has to cover a whole bunch of research and put some real dollars into it, they can very easily charge 1.5%, 2%. Yes, sir. These are annual expense ratios. Yes, sir. I should have made that clear. You're right. The other annual expense, as you see in some funds, are 12B1 fees. They can be anything up to 1%. Not all funds charge 12B1 fees, fortunately. These fees cover nothing other than the marketing and sales. You don't get anything of benefit yourself for it. You're basically paying the fund company for the full-page ads, glossy ads that they're putting in your favorite magazine. You should be aware with mutual funds there's a trap that you don't want to fall into, and it's easy enough to avoid if when you know about it. I've already said that the funds will typically distribute all of their income and capital gains every year. Sometimes they do it annually, sometimes they do it quarterly or twice a year, whatever. But any distributions that they give, you're going to be liable for the tax on it, regardless of whether you keep the check or whether you roll it over and buy more shares in the fund. No matter what you do with the money, you're still going to owe the tax on it, and the fund will report that distribution to the IRS, and you'd better also report it on your 1040 the next April. When they make a distribution, the share price drops by the amount of the distribution. So in the example I've shown here, if you had a $20 share price before distribution, and let's just say the fund made a $1 distribution, the price would immediately drop to $19 for the share price. So you would have a $1 distribution plus $19 share price. You're still whole. You still have $20 worth of investment, but you owe tax on the $1 distribution that you just got. So you need to be careful when you're investing in a mutual fund that you do not do it just before the distribution date, because otherwise you're basically going to be paying taxes on a distribution that means nothing to you. A much better strategy is to check for the distribution date and make your investment after it. Yes, there's a question at the back. No? Okay. Moving on. Closed-end funds. What we've been talking about up to now, mutual funds, the term normally means, is the really open-end funds because they can create more shares as needed. Closed-end funds are similar, except the number of shares is limited to the shares created at the initial offering. They do not have the ability to create new shares as needed, and they're traded just like a stock through a stockbroker. If you need to buy a closed-end fund, you basically go online or pick up the phone and call Schwab or whoever it is and trade with them. They are not valued at the end of each day. The value of a closed-end fund is whatever it comes out to be on the open market from the trading. If it's bid up or bid down, whatever way, whatever the price is during the day, that's it, and there's no cause or no reason to compute a net asset value. So the actual price of the closed-end fund could actually be at a premium to the sum of all of its parts, or it could be at a discount. But it's a little academic because you're going to pay the price on the stock market that it's been valued at, regardless of what the net asset value is. One attribute of closed-end funds that may make them attractive to some people is that they get very little press coverage. They're kind of the lost child of the industry. You know, most people, most investors don't bother with them. Most of the press doesn't bother with them. And because they're somewhat neglected, there's the opportunity that they may trade in a less than efficient market, and there may be some opportunities there. We'll be talking about efficient markets next month, but there may be opportunities here because of that. Yes. No, I'm sorry. No, the question is, what does it mean when I say that shares are limited to the initial offering? I'm saying that at the time the fund is created, the issuer will issue maybe, who knows, 10 million shares at such and such a price, and go out and take all of the money that he gets from that and build a portfolio based on that and manage the portfolio over the years. But there will never be more than those 10 million shares or whatever. So those shares are traded. You can still buy 100, 200, whatever you want any day of the week as often as you like, but the price will be determined by the limited supply, because there will never ever be more than the initial number of shares. Somebody has to sell. The only way you can get shares is it's the same as with stock. Yes. Oh, I don't play in that sandbox personally. Maybe somebody here can suggest some closed-end funds. The question is, what are some examples of closed-end funds? There are closed-end funds for covering all the same turf, the same areas that the open-end mutual funds do. I just don't happen to know off the top of my head any of the tickers for any of them. Any other question on closed-end funds? The question is, why have closed-end funds? What's the advantage of them? Well, the possible advantage, I guess there are a number of potential advantages. One advantage is that they are traded throughout the trading day. You don't have to wait till the end of the trading day to calculate a net asset value and do it. The other advantage for those people who specialize in this area is the fact that they do tend to trade in a less efficient market because does not get much coverage. So theoretically there are potential for opportunity, value opportunities there. Next, I'm going to cover exchange-traded funds. And yes, another question. No, the question is, do day traders use the closed-end funds? Perhaps, but not necessarily. There are a number of folks who buy closed-end funds on a long-term basis. Another question. The question relates to the inefficient market. I'm going to defer that question to the next workshop, because I'm going to be talking about the efficient market hypothesis then in some detail, and at that point it'll be more clear. Yes, sir. The question is, do you measure the volatility of mutual funds in any way? The answer is you calculate the standard deviation just the same as if they were individual stocks. Okay, exchange-traded funds are similar to mutual funds, open-end mutual funds, except, well, they're also somewhat similar to the closed-end funds. They're traded like a stock throughout the day, which is the same as for a closed-end fund. One of the points here is that there's a whole range of trade orders and options available. You can actually get options on exchange-traded funds, various derivatives. The shares are created and destroyed as needed. There's an agent called an authorized participant who has the responsibility of keeping an orderly market and making sure that nothing goes totally crazy in the market, and he has the ability to create or destroy shares as needed in order to do that. One of the advantages of exchange-traded funds is that they tend to be more tax efficient than mutual funds, because the transactions that are made by the authorized participant tend to be in-kind transactions, where he's exchanging a stock for stock rather than selling something and incurring a tax liability. It gets a little esoteric, and I don't want to get into a whole lot of detail on this, but you just take it at face value that they tend to be pretty tax efficient, and that's a good attribute. There are a huge range of passive index ETFs available. Almost all the major benchmarks and indices have, there's somebody has floated an exchange-traded fund to cover that, and there's a growing number of smart beta and active funds becoming available too. In essence, what I'm saying here is that anything you can do in a mutual fund, you can probably do in an exchange-traded fund as well. Exchange-traded funds also have their expenses. They're traded through a broker, so you're likely to pay a commission. A lot of the brokers nowadays have their own family of exchange-traded funds, so if you're buying or selling those, the broker may in fact waive the commission. There'll always be a bid-ask spread, the same as there will be for a stock. That's to cover the market maker's costs. And for the passive ETFs that follow an index and are traded in huge volumes, the bid-ask spread will be very, very tight. It may only be a penny or two, but if you're looking at the emerging market ETFs or something little wilder, that is traded in less frequently, there can be a significant bid-ask spread, so you need to keep an eye on that. Same thing goes for the expense ratio. That covers the ongoing costs for the managers. Again, for the passive funds, it can be very, very low. In fact, it can be less than for a mutual fund, but for some of the more active ETFs, it could be higher. I've said here that ETFs may not be suitable for dollar cost averaging. The reason I'm saying that is because if you're putting $100 a month or whatever into your portfolio, you don't want to do it to an ETF if you have to pay a broker's commission on it. It might be better to find a mutual fund that's similar to the exchange-traded fund, where you can make contributions to it on a regular basis without paying any brokerage commission. But having said that, the exchange-traded funds tend to be slightly cheaper and certainly more tax efficient than the mutual funds. So in my mind, there's room for both of them, in any portfolio. Pardon me. With an exchange-traded fund, you can trade it any time during the day. You can buy it, you can sell it, you can even sell it short. You can use a whole bunch of trade orders, market order, limit order. You can put stop loss orders in, whatever you want, the same as you would for a stock. But there's one danger point, and again, this should be in a flashing red light. If I was able to do that on the slide, I probably could if I was better at PowerPoint. Beware a flash crash. A flash crash, they don't happen very often, but they can be very painful when they do occur. What happens is, with an exchange-traded fund, occasionally, if you take the S&P 500, for example, let's say GE, for some reason, stops trading. Maybe their computers crashed, maybe there's some crazy news came out, and they go off the air for a little bit. There's no way that the exchange-traded fund that owns a certain number of shares of GE or any other company can value its portfolio since it doesn't have the data for that one. It may have data on 499 companies, but it's missing one of them, so it can't come up with a fair value. And that can cause an uncertainty in the price for a short while. There can also be liquidity issues where when something like this occurs, where there's nobody buying and nobody selling, because of the uncertainty, and it means that when this occurs, what typically happens is that the price of the exchange-traded fund suddenly drops sharply because there's nobody out there buying. They don't know the value. They don't know what to bid for it. Normally that wouldn't be a problem, and if you used a market order to sell, you might just be unfortunate enough to hit at a time when this occurred, but it's unlikely. But when something like this happens, the price of the exchange-traded fund can easily drop 20, 30, 50% or more. Actually, some of them occasionally drop all the way down to close to zero. And we've had a couple of these recently. I guess 2 of them in the last 10 years that I can think of. Don't occur very often, fortunately. But the one thing that I would really, really alert everybody to are the stop loss orders. Some folks see stop loss orders as a conservative approach to investing. Supposing you had a portfolio of stocks that were all valued at, let's just say the stock was valued today at $100. You might put in a stop loss order that sold your broker. If this ever drops below $90, sell it on me, because you don't want to risk it going down any lower. And you might think, well, the worst that can happen to me is that I'll get a 10% loss, and I can live with that, if the stock crashes. The problem is if it crashes because of a flash crash, it may trigger the stop loss order at $90, but it won't necessarily sell at 90, because what a stop loss at 90 really means is sell at the first trade below 90, and the first trade might not be at 89, it might be at 50. If the thing really crashed, you could find your portfolio liquidated at $50, and you then go back at the end of the day and see, oh, that's strange. The price is back up to 100 where it opened at the beginning of the day. I wonder what happened. Well, you had a crash in there. The crash triggered your stop loss order. It wiped out, your portfolio at way lower than you wanted. And if you want to replace your portfolio, you have to buy it back at $100. So I would strongly recommend that you use limit orders in all of your trading for exchange-traded funds, just to protect yourself from this. Okay, I've got a little chart in here, and I'm going to go through it quickly because everything on here is we've talked about already. Comparing mutual funds and exchange-traded funds. They both cover a huge range of all the major indices that you're likely to want. Mutual funds can trade either through a broker or the fund family. Exchange-traded funds are typically through a broker. A lot of the fund families now have exchange-traded funds equivalent, so they're closer than ever there. You will normally not pay, or you can buy mutual funds without a brokerage commission. I've already said that there are no-load funds out there. With an exchange-traded fund, you're probably going to pay a smaller commission. It doesn't have to be a big deal. I mean, Schwab is $8.95 or something per trade. They may even waive that if you're buying some of the Schwab funds. The mutual funds are valued and traded at the market close, whereas the ETFs are during the market hours. And all of these sell options and derivatives and so on are available on exchange-traded funds, but not on the mutual funds. And the exchange-traded funds tend to be more tax efficient. But having said all that, I think there really is a place in a lot of portfolios for both, and I wouldn't rule out either of them. They're very comparable. There's some pluses and minuses, but they're both a good approach to building a diversified portfolio. Exchange-traded notes are very similar to an exchange-traded fund. Yes, sir. The question is what makes the exchange-traded funds more tax efficient. One of the earlier slides I showed, where the authorized participant, when he's creating new funds or new shares or liquidating shares, can do it with a like-kind transaction, where he's basically exchanging stocks rather than selling one stock and buying another. It's mostly a legal distinction without a difference. It's a little subtle, but it does mean from the tax viewpoint, if he sold the stocks, or if he was forced to sell the stocks, he would be generating taxable income, whereas if he does an exchange, that can be deferred. It's just an attribute of the way the exchange-traded funds are built, and we don't need to understand the details of it, but just be aware that it does exist. Another question at the back. No. The question was, does that relate to tax loss harvesting? It's got nothing to do with tax loss harvesting. Tax loss harvesting can be used for either mutual funds or exchange-traded funds. Question at the back. question relates to the popularity of exchange-traded funds these days and whether there's any reason not to go into them. I personally like ETFs a lot. I think that they cover most of the needs. The one area that I did highlight a little earlier is that if you are dollar cost averaging into your portfolio, you may not want to pay a brokerage commission every month to add in your $100 or your $1,000 or whatever it is. You might prefer to dollar cost average into a mutual fund first. You can always, at the end of the year, move it over to an exchange-traded fund. But in general, yes, they are becoming more popular and likely to become so in the future. Exchange-traded notes are similar to exchange-traded funds in the way they are built, but and there's some huge differences as well. With the exchange-traded note, they're really a derivative note that pays a return on the portfolio, and the return is typically tied to some index. They do not own the securities in the portfolio, which means that there is a credit risk of the issuer that comes into play. And I've said it's very important here. Again, that very means critically important. You should highlight that in a flashing red light as well. The advantages of the exchange-traded notes are that you may get preferential tax treatment for dividends under certain cases. You know, they're built up in ways that work a little differently around some of the corners of the tax law. I'm not saying it's illegal; it's perfectly legal, but you know, they're structured a little differently to most, and there are prices to pay for that. The other advantage that you may have is if you're investing in master limited partnerships or something like that, you may find that the exchange-traded notes are structured so that they do not have to give you a K1 for your tax returns every year. The due diligence for the issuer here is very, very, very important. So I suggest nobody even should consider exchange-traded notes unless they have expertise in this area, because it is a little dangerous. I think we have a question from the web. The question is, could I comment on inverse and leveraged ETFs? I think the answer is I'd rather not. An inverse ETF is just an exchange-traded fund that's designed on the short term to move in the opposite way to the market. So some folks that think that the market's going to go up, you know, you're betting against the market. It's a way of hedging it. One of the problems, the leveraged ones do the same thing, except they do it, you know, 2 or 3x movement, you know, against the movement of the market. The problem with all of this is that they're really for day traders or for folks that are only looking to do this on a short-term basis, and you will get killed using these on a long-term basis, almost by the definition of the way they're set up. There is, they have no part in the portfolio for a long-term portfolio. REITs. There are 2 types of real estate investment trusts. There's a mortgage REIT, which is a pool of mortgages, and there's an equity REIT, which basically invests in income-producing real estate. It can be apartments, you know, offices, hotels, shopping centers, whatever. Again, they must distribute at least 90% of their taxable income each year. Most of them do 100%. The REIT can deduct any of their dividend payments from their taxable income, but that's the good news. The bad news is you get to pay your share of it on what's distributed to you. One of the pluses in favor of REITs is that, to some extent, not as strong as you'd like, they sometimes move against the stock market. You know, a low correlation with the stock market. If you go back to the crash around 2000, 2001, 2002, REITs were one of the things that held up pretty well through that time. So folks who had diversified their portfolio a little and held at least some percentage of their portfolio in the real estate investment trust did reasonably well, or survived that better than others. On the other hand, in 2008, the REITs crashed just along with everything else, and the only thing that held up then were the bond funds. Rather than invest in individual REITs, there are a whole bunch of mutual funds and exchange-traded funds that allow you to invest in REITs painlessly. Alternative investments, I've already said that I'm not going to spend a whole lot of time on this, but I've just got a couple of warnings here. Commodity mutual funds aren't quite as bad as the rest of stuff on this list. So there are exchange-traded funds and mutual funds that let you invest, for example, in gold or silver or platinum or energy or whatever. And there's probably nothing wrong as long as you're careful with having some small percentage of this, maybe 5% or something like that in your portfolio. One of the reasons for doing this is that commodities tend to give you some level of protection against inflation, so that might be one reason to include some of them. Same thing goes for master limited partnerships, although with the MLPs, you need to be aware that the general partner usually takes a fairly significant chunk off the top, and you may find that you've lost 5 or 10% of your investment, an hour after you've mailed it in. If you've given them $10,000, you might find that there's only 9,000 shows up on your account because there's a 10% front-end load sometimes. Also, the general partner is going to get a share of the profits. I'm not saying that this is unfair. The general partner has a ton of work to do, and he needs to be rewarded. You just need to concern yourself with whether you want to reward him quite this handsomely or not. Hedge funds pride themselves on being able to go anywhere. There's no market that they can't participate in. In the early days, they all claimed absolute, or most of them claimed absolute return. That no matter what market they were in, they could make a buck off it and never go negative. A lot of them, for the last few years, have learned to eat those words, and that's not true anymore. Be aware of how expensive they are. A typical hedge fund will tag you at 2% per annum expense ratio, no matter how well or how poorly they do, plus 20% of the profit. Those are the typical numbers. So you need to get that's a big drag on the return that you get. You need to get they need to get a really good return, to beat the market plus the charges that they're tagging you with. Private equity is obviously mostly just for high net worth investors. I'm not going to spend any time on that here. Common attributes of all of these alternative investments: they tend to be complicated. They tend to be time consuming to analyze. You need to know what you're doing. I mean, it's no place for beginners to dabble, so wait until you make sure that you know what you're doing before you get into this area, if at all. I personally see very little reason to ever do it, but in the interest of full disclosure, I'm giving you the information here. They all tend to be expensive. The hedge funds, 2% plus 20% is a big hit. Some of them have liquidity issues. Some of them, once you've paid your money into it, if you change your mind, you're not going to be able to get your money back, or there may be no secondary market. And even if there is a secondary market, you may only get 50 cents on the dollar back or something for the first 5, 10, 15 years. You're investing for the long haul, and they're not really good at giving you your money back in the interim. Most of them are risky, but we've already seen that risk and return go together. So if you're really chasing high returns and you're willing to take the risk, it may be an opportunity, but I'm not sure that I like it. There's a really good chance in my mind that the return you get will not justify the risk. I said may not here. And these may only be available to accredited investors. The accredited investor is somebody who earns at least, I think it's $200,000 per annum for an individual, or $300,000 per annum for a joint return, and or has a investment portfolio outside of their net worth outside of their home of over $1 million. These are investors that basically the SEC says don't count. You're allowed to buy these investments if you want to, but be aware that we're not regulating them all that well, and you're supposed to have enough smarts to figure all this out for yourself, but there's certainly no place for beginners to play around it. Any questions on anything I've covered so far? Master limited partnerships. The question was whether to stay away from master limited partnerships. Master limited partnerships may be a viable way to invest in real estate, but you need to have the expertise to pick a partnership that's playing in the right area. They're kind of like the REITs. Some of them run chains of nursing homes, maybe, or hospitals, or office buildings or something, and you need to be able to have the expertise to evaluate this before you get into it. And you also obviously need to be aware that they're expensive. You're going to pay typically at least 5% up front to the general partner. So the numbers are better crack so you'll get that back and then a decent return beyond it. I wouldn't say I wouldn't categorically stay away from it, but frankly, with REITs being so readily available as exchange-traded funds, I think that if you're interested in real estate, you can build a diversified real estate portfolio more easily and certainly in a more liquid fashion by buying a REIT ETF. Because that way you can just pick up the phone and sell it anytime you like. Were we talking about the REIT or okay, so the question is how easy is it to trade MLPs? Normally these are sold by the general partner initially, and sometimes the general partner will buy back the shares at a discount. If you have the need later to unload them prior to the whole thing maturing. Sometimes there's a secondary market where folks will buy it back at 50, 60, 70 cents on the dollar, but it's going to be it'll be tough to get your initial investment back if you have to cash out before maturity. Another question from the web. Question relates to having a mutual fund or an ETF in the same area. Wouldn't you be better off always buying the exchange-traded fund so you avoid the mutual fund restrictions? Not necessarily. Again, For those on our webcast, we had a slight interruption here, but we're back on the air again. There are pros and cons for each of them. A lot of folks in the early days set up accounts with the fund families, at Vanguard or Fidelity or whatever, and built up large portfolios of mutual funds. There's no reason to suddenly switch all those over to exchange-traded funds now. On the other hand, if you're making new investments, you may want to do it in the exchange-traded fund, partly because it's a little bit simpler. Oh, I shouldn't even say that. You can go online either way. You can go online, with and buy your exchange-traded fund at any time during the day, or you can go online and make your purchases or sales with the mutual fund as well. But the difference, as I pointed out earlier, is that the exchange-traded funds tend to be a little more tax efficient, so that's an advantage. But on the other hand, mutual funds tend to be a lot more common, certainly if you're dollar cost averaging into it, and in a lot of the retirement accounts, IRAs and 401ks and so on, mutual funds are a more likely thing to do. There's a question over here. Again, it depends. If you buy the mutual fund, if you have made a good choice in your mutual fund, you'll probably have no load to pay. I already said there probably is a no load fund out there for everything you're going to want to do. If you buy the same equivalent type of fund as an exchange-traded fund, you may have to pay a brokerage commission. Now that's all of $8, $9, $10, whatever. It's not a whole lot of money, but if you're doing it month after month, it could all add up. And it depends on the investment. On the other hand, if you already have a large portfolio and you're not making any trades, chances are the exchange-traded fund may have a slightly lower expense ratio than the mutual fund. So I'm not going to say that one is better than the others. I think there's an argument to be made for both of them. And I know a number of folks who have a mix of both mutual funds and exchange-traded funds in their portfolio. Any other questions? This lady back here. The question regards REITs. What's a typical charge for managing a REIT? Most of the REIT ETFs that I'm aware of have an expense ratio that's, I'm doing this off the top of my head, my guess would be 0.5% or less. They're a little more expensive than a large cap fund or something like that because there are some management issues involved, but it's not huge. It's not of the order of 1 or 2%. Question? Okay. Yes, quickly. A mutual fund, yes. If the mutual fund has a high turnover rate, you're probably triggering a bunch of tax. The question related to turnover and tax issues. Yes, you could well be generating some tax issues with a high turnover. General attributes for alternative investments: complicated, time-consuming, expensive. I think I've covered all of these. In summary, we've covered your PIP. We've covered methods to measure return and methods to measure risk. We've looked at a bunch of investment vehicles. So for next month, we're going to discuss building a diversified portfolio. We're going to spend some time initially on modern portfolio theory and the efficient market hypothesis, and then we're going to look at the characteristics of the various asset classes. And then we're going to get into building your portfolio and figuring out how and when to rebalance it. And finally, we'll wrap up with a look at the second document that I'm going to ask you to prepare, and that's your IPS, your investment policy statement. For those of you who are going to be coming back next month and want a homework assignment, I'm not going to grade any of these. I don't want to see them, but it would be useful to you, I think, if you did this. First of all, open an All About Me folder. You may even want to make it a ring book, because by the time we get to the estate planning, you're going to need a ring book. Do a one-page PIP, and that probably means going online and downloading a questionnaire and then writing up a half-page or one page on the PIP covering the issues that I talked about. You may want to check your retirement accounts and calculate the compound annual growth rate and the standard deviation of the Sharpe Ratio on either a 5-year or 10-year basis. I said your retirement accounts because you probably have better records for those than the other accounts. I've given you a whole list of reading materials here if anybody wants to get into it and probe a little further. I've given you some websites, and the websites include AAII.com, which is a broad selection of material back there. I've given you the Santa Clara County Library website where you have access to Morningstar, Standard & Poor's, and Value Line. A whole bunch of other funds that have a ton of good material on it. And finally, our website at the bottom for the local, Silicon Valley, AAI.org, where all of our presentations, or most of our presentations from previous talks are on there. And finally, end up with the mandatory cartoon. Are you ready to start investing, or do you want to keep throwing your money away on food and clothing and shelter? Thank you, folks.